This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Stocks slide, more geopolitical concerns erupt, and the Dow turns in its second worst week of the year.
Active versus passive. The debate rages on, and there's new fuel to add to the fire.
And how to turn life lessons into success on and off the field. New England Patriots coach Bill Belichick shares his wisdom. We have those stories and more tonight on Nightly Business Report for Thursday, April 13th. And good evening, everyone. I'm Contessa Brewer, in tonight for Sue Herrera.
And welcome, everybody. I'm Tyler Matheson. It was a tough week, a short one, but a tough one for stocks. Second worst week of the year, second weekly slide in a row. Today's declines were minor early in the session, but then steepened midday. On news, the U.S. dropped what's known as the mother of all bombs, the country's largest non-nuclear explosive, on a suspected ISIS tunnel complex in Afghanistan. The Dow and the S&P then closed at the lowest levels in 2 months. Today, the blue-chip Dow index lost 138 points. NASDAQ was down by about 31 points, and the S&P 500 fell nearly 16. For the week, the Dow was down nearly 1%, the NASDAQ off by more than 1.2%, and the S&P 500 also fell a little more than 1%. And the results put the markets back at levels last seen during the beginning of the president's term.
Now to today's top corporate story, financials. It's report card time for the world's biggest companies. The big banks kicking off earnings season with their results released before the opening bell. And here are the numbers. First, JP Chase beat on both the top and bottom lines. Earnings coming in at $1.65 a share and revenue at more than $25 billion, up by 6% when compared with the same period last year. Wells Fargo's results were mixed. Earnings beat at $1 a share, while revenue missed slightly. And Citi managed to top consensus on both fronts. Earnings came in at $1.35, an increase of 17%. Last but not least, PNC Financial, also a beat on the top and bottom lines. Earnings were at $1.96 a share, well above estimates. Wilfred Frost digs a little deeper into those reports for us.
Banks' earnings initially looked positive across the board, with EPS beats for all the big names. However, there were some hidden issues, most notably for Wells Fargo, whose expenses rose more than expected, in part due to the distractions of dealing with the sales scandal. CEO Tim Sloan addressed how the scandal has impacted the company on the earnings call.
Of course, it's having an impact on the performance of the company. I mean, I think that when you step back and you look at how serious the retail sales practice issues were, and the reputational impact on the company, you can only reach that conclusion.
Loan growth was also a little soft, and Wells Fargo does not have much investment banking exposure to offset it, where performance was better. Both Citi and JP Morgan saw strong bond issuance balance out lower corporate loans, as well as strong trading numbers. Credit quality for all three was relatively benign, despite some investor fears coming into earnings. Following March's rate hike, all banks were expected to see net interest income improve, although JP Morgan and regional lender PNC were the only ones to meaningfully deliver. For Nightly Business Report, I'm Wilfred Frost.
A new study out today by S&P Dow Jones Indices shedding new light on a debate we've frequently pointed to here on Nightly Business Report, the question of which investment strategy is more effective, active or passive management. Before today, S&P never released data comparing those two strategies over a 15-year period. And as Dominic Chu reports, the results may cause you to rethink how you invest.
There's a large part of the investment community that believes the average investor needs to invest in the averages. Over the course of the last decade plus, index fund investing has been the better option. According to data from S&P Dow Jones Indices, over the last 15 years, 92% of domestic large-cap fund managers did not manage to outperform the benchmark S&P 500 index. 95% of domestic mid-cap fund managers failed to beat their benchmark, and 93% of domestic small-cap managers underperformed as well.
Passive is a very valuable way of investing, but it's not the only way of investing. There are a number of issues around passive indexes. They have particular ways of being built. which create opportunity for active management. They have biases in them that creates opportunity.
A strong case can be made for why investors should just aspire to be average when it comes to investing. If you have a long time horizon and believe the economy will do better tomorrow than it is today, then you'll benefit from just owning stocks in the index. And in many cases, index funds have very low management fees compared to funds run by stock pickers. But many proponents of active management say that smart and insightful research could be poised for a comeback in the coming months and years.
The more change there is going on in the global economy, the domestic economy, changes in regulation, changes in opportunity, creation of new technologies, those are all things which create opportunity for active managers.
Index investing has been championed by the likes of industry legends like Jack Bogle of the Vanguard Group and billionaire investor Warren Buffett. But a case can be made for using a bit of both active and passive fund management. For Nightly Business Report, I'm Dominic Chu.
Well, despite the information today's report provides, we're still left with some crucial questions. Are there pockets of the market where active management is worth paying for? If so, which ones? Joining us now to shed some light on the issue is Ben Johnson, Director of Global ETF Research at Morningstar. Ben, good to have you with us tonight. So I got to just get to the big first question. Based on that report, is there any role in investment? Why would you ever go with an active fund, an actively managed fund?
Well, thank you for having me, and it's a terrific question. And certainly the numbers don't lie. The odds are stacked against active managers, but that's not to say that there aren't pockets of the market where active managers have better odds of adding value relative to their benchmark. It's also not to say that there aren't certain shortcuts that investors can take to winnow down the field of active managers and boost the probability that they'll be able to pick a winner.
So let's cut to the chase there, Ben. You just mentioned the opening for me. Are there pockets of the market where my odds of beating the benchmark or not underperforming it are better than others? If so, which ones and what are those odds?
If you look outside of U.S. equities, so go above and beyond U.S. large, mid, and small caps, where the world is flat, it's hotly competitive. You've got some of the best managers ever. It's not that these managers, these analysts aren't skilled. It's that they're so highly skilled that the information that they're using is so advanced, so broadly available, that it's become exceedingly difficult to develop any sort of sustainable edge. So if you go outside of U.S. equities into developed international equities, into emerging markets equities, and in particular into the bond space and look at fixed income funds, what we've seen in our Morningstar Active Passive Barometer is that success rates amongst active managers in those categories are markedly higher than those of their peers that are managing U.S. equity funds.
But do the majority of those managers beat the benchmark, or is their performance just markedly higher than the ones in this study that showed that 92% failed, 95% failed, 93% failed? You get my point.
I get your point, Tyler, and it's a good point. So the majority still falls short over most time periods. So your odds of picking a winner are still, if you were to select one at random, worse than a coin flip. Now, you can improve those odds, I should stress, by selecting from amongst the lowest cost managers, the lowest cost funds in all of those categories. And in all cases, what we've seen is that funds that have the lowest cost relative to their peers have above average odds of success.
So, Ben, are we going to see, because of this report, some competitive pressure for the active managers to reduce their fees, becoming more competitive with their benchmarks?
I absolutely expect that the pressure, which already exists on active managers to reduce their fees, to become more active, quite frankly. What you're seeing in terms of the washout, the mass exodus from certain U.S. equity funds isn't so much people leaving active funds as it's people leaving high-priced closet indexers, so active management prices for index-like or even worse performance. So I think it's going to force active fees to come down. I think it's going to force active managers to be more truly active.
Ben Johnson with Morningstar. Thanks, Ben.
Thank you.
And coming up, the comeback in steel jobs.
The Trump administration has promised a steel revival in the United States. It all starts here, coming up on Nightly Business Report.
An update now on United Airlines. The lawyer for David Dow, the passenger you see here who was dragged off that United flight Sunday, spoke out today. Lawyers for him, that is. They listed his client's injuries, the lawyer did, including a broken nose, a concussion, 2 knocked out teeth, and sinus problems that may require reconstructive surgery. Dow's lawyer blamed his client's injury on a culture of disrespect at United Airlines, so much for the friendly skies, and overly aggressive tactics from the Chicago Aviation Police. When asked if there will be a lawsuit, Dow's lawyer said most likely. Following the press conference, United issued yet another statement on the matter saying, quote, "We continue to express our sincerest apology to Dr. Dow. We cannot stress enough that we remain steadfast in our commitment to make this right." Today's shares of United off more than 1%.
Okay, so Apple is reportedly developing technology for treating diabetes, and that's where we begin tonight's market focus. According to CNBC, the tech giant has quietly assembled a team of biomedical engineers who for years have been working on creating non-invasive sensors that can monitor blood sugar levels. The genesis of the initiative is said to have come from Apple's co-founder, Steve Jobs. The report also adds that Apple has conducted some feasibility trials at some clinical sites. Shares were off a fraction to 141.05.
JCPenney is pushing back the closure date for the nearly 140 stores it plans to shut down. The reason, better than expected sales and foot traffic lately. The retailer also said it would postpone its liquidation sale as it looks to sell spring and summer merchandise at the current discounts. Shares of JCP fell more than 1.5% to $5.91.
Tesla CEO Elon Musk said today the automaker will unveil its semi-truck this September. In a tweet, Musk called the vehicle, quote, "seriously next level." He also said the company will unveil a pickup truck in 18 to 24 months. Tesla shares rose more than 2% to $304. President Trump has promised to make American steel great again, and steel manufacturers are ready. Jackie DeAngelis has the story from Mountain Iron, Minnesota.
In northern Minnesota, they're blasting, digging, and trucking towards an American infrastructure revival by mining for a key component of steel.
It all starts here with the iron ore production.
Larry Sutherland is general manager of U.S. Steel's Mining Solutions.
We produce approximately 25 million net tons annually of iron ore pellets.
It's that iron ore that's shipped off in pellet form to U.S. Steel's Gary, Indiana Gary Works facility, where it's melted, mixed, and formed into some 300 or more types of steel, which is then trucked off in massive coils to be cut into parts for products from ovens to cars to buildings and bridges.
It's impressive the products that we make here that help support American families and the things that they use.
The steel industry has faced its share of competition from overseas manufacturers. Among the challenges, what it says are anti-competitive trade policies and foreign government subsidies, which make some grades of steel cheaper. But all that could change.
Steel made in this country and pipelines made in this country.
President Trump has asked for pipeline steel to be made in the USA, and U.S. Steel says that's bullish for its business.
We have all the necessary high-cost materials that would go into cost-effectively making steel, but we've got to have a level playing field to compete.
The company and the industry are preparing to make more steel at home, and they're excited about the prospects, according to Doug Matthews, Vice President of Mining Solutions for U.S. Steel.
We just did an investment here last month, as a matter of fact, in our hot strip mill, where we did some upgrades to the equipment to even expand our capability.
Industry officials say increased business means more jobs, better morale, and hope for an industry of multi-generational workers that have invested their heart and soul in America.
Make America great again, make steel great again. These are all connecting parts of our tissue here, the human spirit here at Gary Works. People are hoping that better times are coming.
Back here is where American-made steel truly starts. With these iron ore pellets, there's no shortage of product, and there's no shortage of hope that President Trump's policies will create incentives to not just stamp pipelines made in America, but nearly all other products and projects that require steel. For Nightly Business Report, I'm Jackie DeAngelis, Mountain Iron, Minnesota.
And back to the broader markets we go, and our market monitor, who says at this stage of what he describes as a tired bull market, investors should focus on companies with strong earnings growth. This is first time on the program. We promise to be gentle. Oliver Porsche, CEO of Bruderman Brothers. Welcome. Good to have you with us.
Thank you.
Let's cut straight. You're one of these brave, active stock pickers. We've been talking about active versus passive, but here you are. Give us some stocks that are going to outperform the markets, beginning with BCE Media.
BCE, the old Canadian telecom. Think of it as the Verizon and AT&T of Canada. Right, solid footprint in the residential market, solid footprint in wireless, and now making great inroads in kind of the small middle market companies out there, so on the commercial side. And so there's tremendous growth outlook, solid dividend, great balance sheet. If you're looking to be defensive in a market that's likely to go sideways and face a correction over 8 years into the bull market, this is a great core holding.
You also are looking at a defensive utility investment as well.
Yeah, again, strong balance sheet. What is going to win? So early cycle of interest rate hikes, utilities do very, very well. And so they do well from an earnings front. They have the power to raise their dividend if they have a strong balance sheet. PPL is an example of this. Again, it's about being defensive in this type of market. You know, you're 8.5 years in on economic growth that's going to be circa 2% or so. You've got to be a little bit more careful as an investor.
And another one that you could call defensive would be AbbVie, pharmaceutical.
Yeah, so AbbVie, it's a pharmaceutical biotech company, great product line, great research out of the company, lots of attractive things. It's a little bit more growth-oriented than the other two stocks that we mentioned, but certainly still within that overall space, somewhat conservative. Our approach at Bruderman is very simple. Given two companies that are alike and two investment choices that are alike, we're going to go with a more conservative approach each time.
Oliver, there's been so much optimism about this so-called Trump rally. What are the geopolitical realities now doing to that optimism?
Well, I think it's dampening a little bit. I think that what President Trump is finding out and what investors are finding out that were very, very bullish about it after his election is that these things don't happen overnight. And just because you have a breath of fresh air, if you want to call it that, or somebody new in the White House, doesn't mean that he gets to do what he wants, when he wants it, how he wants it, and as quickly as he wants it. Hey, tax reform may still happen, right? There's certainly been a lot of things that have occurred in the last few months that many thought were going to take a lot longer. But it's still a long, drawn-out process. And the political reality, the greatest one, is that he is facing a very combative Democratic caucus, and that's going to slow things down further.
And a fractious Republican caucus as well.
Yeah, the infighting isn't helping.
Thanks very much, Oliver Porsche with Bruderman Brothers. Appreciate it.
Thank you.
Still ahead, the battle of the brews.
Coming up on Nightly Business Report, what is craft and why are the mega brewers so thirsty to get in?
Here's a look at what to watch tomorrow. The markets, of course, will be closed because it's Good Friday, but there is still plenty of data coming out. The Consumer Price Index, an important inflation indicator, will be released in the morning. We'll also get retail sales data, plus a read on business inventories. And that, folks, is what to watch for a Good Friday.
You might argue a successful football coach is more than a little bit like a successful CEO. They have to manage different units, different personalities, and they have to take risks. And with more than 4 decades of coaching experience and 5 Super Bowl championships, Bill Belichick, head coach of the New England Patriots, is widely considered one of the best coaches in football history, quite possibly the best. He learned plenty along the way, and in an exclusive and rare interview with Susie Welch, he shares his lessons.
What would you call your most defining moments of your career, where you learned the most?
Well, where I probably learned the most is my first year in 1975, because I took a job, was given a job with the Colts, and I didn't have any experience, and they were very understaffed. I wasn't getting paid anything, but I had a lot of responsibility for that position. Right. And so I was able to learn a lot. It was like having 2 or 3 graduate courses in 1 year. After that year, when I went to Detroit, we were 1-4. We were playing the Patriots, who were 4-1. They had a great team. And I went back to an experience that I had in Baltimore. I kind of talked to our offensive coordinator at that time and said, look, I know we haven't ever used this formation, but you know, I studied this formation when I was in Baltimore last year. I think this is really going to give the Patriots a problem. Can we take a look at this? So we went through it, we looked at it, we used it, and we won the game by 3 touchdowns. It was a huge upset. That was kind of one of those where I'm like, okay, I can coach in this league.
What did you take away from
that? It's a good, that don't be afraid to use a good idea just because it's unconventional, just because somebody else hasn't done it. If you believe in it's a good idea, then don't be afraid to use it. So fast forward, I take the job with the Patriots in 2000. The first meeting we have in the spring, this is back in the old Foxborough Stadium, so it's kind of a small room. We're squeezing the whole team in there. And here comes in the guy's first-round draft pick from a prior year, walks into the front of the meeting, not into the back, walks into the front and kind of sits down. And I've already started the meeting. I'm 3-4 minutes into it. And, I just look at him like, what are you doing? He said, sorry, coach. Like, sorry, just get out of here. We're not going to start this program off with you walking in whenever you feel like walking in. I don't care if the guy's the #1 draft choice or not a #1 draft choice. We're just not going to run a team like this.
Yes. Susie joins us now with more on what Bill Belichick had to say. How does his view of leadership on focusing on that dependable member of the team rather than the star player line up with what you know about leadership and what's been taught about leadership?
Yeah, I think it's so different from what you're taught, and actually, even more importantly, what managers end up doing in real life. In real life, you are a manager and you count on your stars to hit the ball out of the park to impress your boss, and you really want your stars to outperform. And he himself says he learned the hard way. That's not the way to do it, and he will take a dependable, consistent, reliable player over talent any day. That to me was one of the most provocative things he said. And it made me wonder in my own management career, did I really count on those stars to hit the ball, or did I give enough credit to the people who always delivered for me when I needed them?
My sense of him is not so much that he is a control freak, and he's probably less so than he was when he was a younger guy, but that he's a process freak, that there's a certain way that he does it every year, and he replicates that, and that's part of the magic, right?
You're very close to, he's a preparation freak.
Preparation freak.
And that's part of his process is preparation for every scenario, and so that everybody knows anything they're going to run this formation. This is all the things that could happen. What will we do? And then to have such incredible teamwork built through all sorts of exercises, from trivia nights to training with the SEALs, so that if they have to adjust on the field instantly, they can do it wordlessly. They can do it seamlessly. They don't need to have somebody tell them how to do it. That preparation plus teamwork, that's their process.
I've been reading a lot of research recently that indicates that the real key to success is grit, that stick-to-itiveness, the ability to work hard to overcome obstacles. Is he passing that along to his players as well? I mean, Tom Brady, star quarterback. Is he a guy who's using grit to get where he wants to be?
Well, this is what he makes it. Grit is exactly what he admires in a player, and he actually thinks it's more important than talent. This working on yourself. He says Tom Brady's not a great natural athlete. He says it very bluntly in the interview, much more bluntly. I was taken aback.
Did.
I mean, he was very straightforward saying he's not a great natural athlete. He had the tenacity to keep working on himself and the self-awareness that working on himself could never stop. And he said even after he's won all these Super Bowls, Tom Brady works every single day on himself. I mean, I think it's very encouraging for people who don't have natural talent in a pursuit that they love. For all of us.
I'd love to be as unnatural a talent as Tom Brady.
Tom Brady.
Susie Welch, it's really fun.
Thank you
really
so much. Thank you.
As I said earlier to you today, you did something that I didn't think was possible. You made me like Bill Belichick as a New Yorker. Thanks so much. From football to beer, and I don't know why Contessa Brewer isn't reading this, but if you've been shopping recently for beer, you've probably noticed the shelves are stocked with brands you never heard of. You can blame it on the craft brewing craze. Craft brewers may be defined as companies producing less than 6 million barrels of the foamy stuff a year. But that is not stopping the big firms from getting in on the action. Landon Dowdy has that story tonight from Washington, D.C.
This double IPA.
Brandon Skull is one of the many craft brewers making a name for himself in D.C. And his business is growing with plans to more than triple production from the 15,000 plus barrels his company, D.C. Brow, produces a year. While overall beer sales are dead on flat, last year craft brewers posted 6% volume growth. And Big Beer is getting in on the action. Take AB InBev. In the last 5 years, it bought up 9 craft brewers to get in on the trend. Miller Coors purchased 4. So what's in it for the craft brewers?
When a company like AB InBev or Miller Coors purchases a brewery, it certainly gives them additional advantages in the marketplace, access to distribution and retailers that they wouldn't have as an independent brewer. And so it does create challenges, particularly for regional craft brewers that are going head-to-head in the same scale retail channels as those larger brewers.
Cheers. But how does the consumer feel when one of their once small, independent, often local, and usually cool craft brands cashes in by selling to a macro brewer?
It would hurt their image a little bit as a craft brewery that has sold out to a larger brewery. But overall, I think if the beer, still speaks volumes to what they're doing, I think it's still good beer.
Consolidating by buying up craft brewers is one way big beer companies eliminate competition. Skol says the craft companies aren't really going head-to-head.
I would say that it's a little bit of a different industry from most, because our direct competitor is not necessarily our craft brewery friends down the street. It's more of the big macro. It's a very clear example of a rising tide lifting all ships.
With a record 5,200 plus breweries operating, competition for tap and shelf space is fierce.
There you go, sir.
While big brewers have a lot to offer, the question becomes one of priorities. And for now, Skol is staying true to his craft. For Nightly Business Report, I'm Landon Dowdy in Washington.
You gotta love a good brewer. That's Nightly Business Report for tonight. I'm Contessa Brewer.
All right, thanks for watching, everybody. I'm Tyler Matheson, and I like a good brewer, too. Have a nice evening, everybody. We'll see you tomorrow.